Setting realistic profit targets and stop losses. Setting profit targets and stop losses sounds simple on the surface, almost mechanical. But in real trading, it's one of the most emotional and revealing parts of the process, because the numbers you choose quietly expose how you think about risk patience and your own need to be right. I've watched traders survive bad entries, bad timing, even bad market conditions. But I've seen very few survive consistently unrealistic targets and undefined exits. After living through the dot-com bubble, the 2008 crisis, and the COVID volatility, I can tell you with certainty that most accounts don't die from one big mistake, they bleed out slowly. From small decisions made without realism or respect for probability. Early in my career, I treated profit targets like wishes. I'd look at a chart, imagine how good it would feel if price reached a certain level, and then convince myself that level was logical. It wasn't. It was emotional. I wanted the trade to justify the risk I had taken, and instead of adjusting the risk, I adjusted the expectation. That's backwards, and the market punishes that thinking relentlessly. Realistic profit targets don't start with how much you want to make. They start with how the market actually moves under current conditions, how much liquidity is available, and how often similar setups have delivered follow-through in the past. Stop losses reveal even more. A stop loss is not a prediction that price will reverse. At a certain point, it's an admission that your idea can be wrong. Many traders struggle with stops, not because they don't understand them, but because placing a stop forces emotional honesty. You have to define where the trade no longer makes sense, not where you start feeling uncomfortable. Those are very different places. Discomfort is psychological. Invalidity is structural. When you place stops based on fear rather than logic, you get chopped up. When you place no stop at all, you're not confident you're exposed. One of the biggest mistakes I see is people setting targets that don't match their time frame. They say they're trading short-term, but their targets assume long-term trends. Or they say they're investors, but their stops are so tight, they can't tolerate normal volatility. This mismatch creates constant frustration. You're either stopping out of good ideas or holding bad ones too long, and over time, you lose trust in your own system. Realism begins with alignment. Your profit targets, stop losses, and holding period must all belong to the same world. Markets also change, and realistic levels change with them. In low volatility liquid environments, price tends to move in measured steps. Targets can be tighter, stops more precise. In high volatility or thin markets, price overshoots, snaps back, and behaves erratically. In those conditions, insisting on the same tight stops and perfect targets is not discipline, it's denial. Experienced traders adjust. They may trade smaller, widened stops, lower expectations, or step aside entirely. The realism is not in the number, it's in the adaptation. Another hard truth is that good risk-reward ratios don't come from stretching targets unrealistically far. They come from entering trades where the market structure already offers asymmetric opportunity. If you have to hope price runs far to make the trade worthwhile, the trade was never good to begin with. Professionals don't force reward to justify risk. They select risk where reward is naturally available. That distinction is subtle, but it's the difference between trading probabilities and trading fantasies. Emotionally, profit targets are where greed hides, and stop losses are where fear hides. Greed whispers that you should hold just a little longer. Fear whispers that you should move the stop just a little farther. Both sound reasonable in the moment, and both quietly destroy consistency over time. The traders who last are not immune to these voices. They've simply built rules that prevent negotiation once the trade is on. Targets and stops are decided when the mind is calm, not while price is moving. I learned this lesson painfully during 2008. I had trades that went in my favor quickly, And instead of taking realistic profits in a collapsing market, I tried to extract every last dollar. Liquidity vanished, volatility exploded, and profits evaporated faster than I thought possible. On the other side, I held losing positions far beyond where they made sense because I couldn't accept being wrong in such an extreme environment. That experience taught me that realistic targets and stops are not about maximizing gains or minimizing losses in isolation. They're about staying functional under stress. As this begins to sink in, you realize that setting targets and stops is not a technical exercise. It's a psychological contract with yourself. It defines how much uncertainty you're willing to tolerate, how much pain you can absorb, and how disciplined you'll remain when emotions rise. If those levels are unrealistic, everything else in your trading will feel unstable, no matter how good your analysis is. And that instability is exactly what we need to address next, as we move from understanding why realism matters into learning how to actually define profit targets and stop losses in a way that fits your strategy, your personality, and the market you're trading right now, rather than the one you wish you were trading. And that is where we continue next, as this thought carries forward into the practical framework for setting exits that protect both your capital and your mindset. When the pressure is real and the decision has to be honored without hesitation, by grounding them in structure instead of emotion. Because once a trade is live, your brain is no longer a neutral observer. It is a defense attorney arguing for whatever position you already hold. That is why realistic profit targets and stop losses must be designed before you enter, when you are still capable of honesty. The first step is always defining invalidation. Ask yourself very plainly, what has to be true for this trade idea to make sense, and where that truth would clearly no longer hold. That point is not arbitrary, and it is not based on pain tolerance. It is based on market structure, on where the logic of the setup breaks. If price reaches that level, the trade is not temporarily uncomfortable. It is wrong, and accepting that distinction is what separates discipline from hope. Once invalidation is clear, position sizing does the heavy lifting. Too many traders try to fix emotional discomfort by moving stops when the real problem is size. If your stop feels unbearable, the market is not the issue, your exposure is. Professionals work backwards. They decide how much they are willing to lose on the idea, then size the position so that the structural stop fits inside that risk. This keeps the stop where it belongs and keeps your mind functional when price moves against you. A stop that exists only on the chart, but not in your psychology, will not be honored under pressure. Profit targets come next, and this is where realism is tested. A target should be based on what the market has demonstrated it can do in similar conditions, not on what would make the trade feel worthwhile. Look left on the chart. How far do moves typically travel before stalling or reversing? Where does liquidity tend to sit? In calm markets, extensions may be clean and measured. In volatile markets, they may be sharp but brief. A realistic target acknowledges that behavior. It doesn't assume the market will suddenly behave better just because you're involved. One of the most practical techniques I've used for decades is scaling. Instead of betting everything on one perfect exit, you take partial profits as the market offers them. This does two things. First, it pays you for being right early, reducing psychological pressure. Second, it allows you to hold a smaller remainder for further upside without turning the trade into an emotional hostage situation. Scaling is not about being indecisive. It's about respecting uncertainty. Markets rarely give you everything you want at once, and traders who insist on all or nothing outcomes often end up with nothing. Stops can be managed the same way, but with discipline. Moving a stop to reduce risk after the market has proven your idea correct is not the same as moving a stop to avoid loss. The former is strategic. The latter is emotional. The difference is intent and timing. If you find yourself adjusting stops frequently while price is still undecided, you are negotiating, not managing. Realistic stop management happens after confirmation, not before. Another critical piece is aligning exits with your time frame. If you are trading short-term, your targets should be hit quickly or not at all. If they aren't, that's information. Long-term investors, on the other hand, must allow for drawdowns and volatility without micromanaging. Problems arise when traders mix these approaches, taking short-term stops on long-term ideas, or holding short-term trades with long-term hope. Clarity here removes a tremendous amount of stress and self-doubt. Over many cycles, I also learned the value of pre-acceptance. Before entering a trade, I mentally accept the full loss defined by my stop, not in a dramatic way, but in a factual one. If I am not comfortable losing that amount, I do not take the trade. This simple habit eliminates a huge amount of emotional interference later. When the loss is already accepted, fear loses its leverage. When fear loses leverage, discipline becomes much easier to maintain. As we come to the end of this lesson, understand this clearly. Profit targets and stop losses are not there to make you money. They are there to keep you consistent. Money is a byproduct of consistency over time. Unrealistic targets create frustration. Undefined stops create fear. Both erode trust in yourself. Realistic exits, on the other hand, build confidence quietly, trade by trade, because you are doing what you said you would do, regardless of outcome. That consistency is what allowed me to survive multiple market cycles without blowing up. Not because I was right more often than others, but because when I was wrong, the damage was controlled. And when I was right, I took what the market was willing to give instead of demanding what it wasn't. If this perspective helped you rethink how you set profit targets and stop losses, I invite you to subscribe to the channel so you can continue learning from real live market experience. And leave a comment sharing the biggest mistake you've made with exits in the past, because bringing that mistake into the open is often the first step toward never repeating it again.